Welcome back to the Executive Explainer. Let's just dive right in because we've got a lot to unpack for the EVA weekly report and future trend for this fourth week of August 2026. So, looking at the big picture, the overarching global macroeconomic theme this week, it is undeniably cautious. We're talking about a heavily pessimistic buying pulse right now. Demand across multiple sectors is, frankly, just weak. Buyers are hesitant, processors are sweating the details, and honestly, understanding this global hesitation is absolutely crucial to unlocking the localized data we're about to dig into. It's exactly why you need up-to-the-minute data in an environment like this. Because globally, the market is literally all over the place. It's severely fragmented. We've got completely different trajectories across the major hubs. Over in the US bazaar, demand is weak, dragging prices down to $1,370 a metric ton. But then, look at Europe. They're actually showing signs of strengthening demand, pushing up to $1,700. And China? Well, China's kind of stuck in this stagnant middle ground, dull demand holding at RMB 10,450. We are definitely not looking at a synchronized global economy here. It's a region-by-region battlefield. Let's zoom in on the US for a second. That $54 drop tells a very distinct story. Persistent weak demand has just hammered FAS Houston prices, knocking them down to $1,370 per metric ton. When demand stays this soft, sellers have no choice but to adjust, right? So that drop is really just a direct reflection of a market desperately trying to find its floor. But then you jump across the Atlantic, and it's a completely different vibe. The European market actually jumped by $48. So why the sudden spike to $1,700 a ton? Well, it's all about anticipation. Participants over there are actively expecting demand to strengthen in the near term. It's totally sentiment-driven. Buyers are forecasting a tighter market, and that anticipation alone is driving prices up, completely bucking that downward trend we just saw in the US. And moving eastward, China is dealing with this fascinating paradox. Key segments are seeing reduced manufacturing output, which, naturally leads to that dull demand we talked about. Buyers are tightening their belts, hunting for cheap variants instead of premium stock. But here's the kicker. Supply is also tight, so despite the dull demand, those tight supply constraints are basically pinning spot prices down at RMB 10,450. It's a total standoff between cautious buyers and constrained sellers. All right, that covers our global macro tour. Let's bring it closer to home and pivot to Act 3, the Indian Bazaar highlights, where we'll look at spot prices, exchange rates, and the buying pulse. Now, pricing dynamics in India require a really careful read this week. Overseas EVA 18% offers have actually corrected downward to around $1,385 to $1,390 per metric ton CIF Navasheva. But locally, the plot thickens. Mundra spot prices have strengthened, sitting at $140 to $142 per kilo ex-GST. So international offers are softening, while local spot prices are showing some serious resilience. It's a tricky spread and for sure something you need to be monitoring daily. Oh, and adding a whole other layer of complexity here is a major shift in currency valuations. Effective August 21st, India's customs rates were revised upward. The new import rate is now sitting at rupees 96.50 to the dollar, and the export rate is at rupees 94.80. That gap, and honestly the upward revision itself, hits your landed costs directly. If you haven't plugged these new rates into your end-of-month margin calculations yet, you're going to want to do that today. So what does all this pricing and currency chaos mean on the ground? Well, it takes us right to the buying pulse, and frankly, the trading atmosphere is pessimistic. Processors are totally sidelined right now. Why? Because they have zero interest in building up raw material inventory. And the obvious reason is poor finished product sales. Plus, retail is already sitting on ample stock. There's this massive bottleneck at the consumer end, and it's rippling all the way back up the chain to raw material procurement. So how should you play this? The recommendation this week is crystal clear. If purchases don't pick up, traders are probably going to start offering discounts on spot sales. So our advice? Buy strictly on a need basis for now. That is your biggest actionable takeaway for this explainer. Don't over-leverage, do not build speculative inventory. Literally, just buy what you absolutely need to keep the lights on and the machines running, and wait to see if those spot discounts actually show up. And look, navigating this kind of volatility means you need constant information, right? You can grab the full instant PDF report over at polymerbazaar.com, or if you want rapid updates, their tech setup is awesome. Just WhatsApp the word EVA to +91 93746 24365, and their AI bot hits you back in like 5 seconds. Need to actually talk it out? Their relationship managers and customer care team are standing by on the numbers provided. Before we wrap up this explainer, I want to leave you with something to chew on as you plan out the rest of your week. We've just seen Europe bracing for stronger demand and pushing prices higher, while the US and China are totally stalling out. Given that massive global imbalance, how long can Indian processors really afford to wait on the sidelines? Are you going to hold out for spot discounts? Or will global supply constraints suddenly dictate the next big price shift before you even have a chance to react? Timing your re-entry is going to be the ultimate test this quarter. Thanks so much for tuning in to unpack these insights with me, and I'll see you in the next explainer.